TheoTrade. This is Don Kaufman. October 28th, 2020. About 12 minutes to go to the cash close here on this Wednesday afternoon, with the S&Ps just getting decimated in trade today, down about 3%. I got to tell you, by the looks of this morning, this could have been a lot worse in today's trading session. Let's get to actually work and kind of break this down. I mean, hey, with only a few minutes to go to the cash close, you're seeing kind of an all-out full-court press into the cash close, and that is some heavy sell-side activity. I'll tell you, on a trading session like this, do not get caught in that last 15 to 20 minutes cash close. Again, contract size, you can see it picking up here inside of the S&Ps, and it's getting a little bit wicked out there. Listen, we're only a few handles off the session lows. But again, so you have about 10 minutes to go to the cash close. Of course, the futures contracts are going to be open after the cash close, and you're likely to see this this close at or very close to the session lows. There are some really definitive aspects to point out in today's sell side activity that have not been prevalent in the recent selling, specifically earlier this week. We're also going to look at the a little bit of a statistical analysis here of some of the sell side activity. Again, I am ever the quantitative trader, but there's just no question right now. Listen, these market bears, they're making a comeback, and they're doing it in a wild fashion here. So as I was saying, couple of minutes to go to the cash close, the pressure is on, the volatility is exploding. One of the first things that I want to point out about today's trading session that is in big time kind of contrast, it's where the sell side activity is coming from. First and foremost, if you tuned in early trade this morning, that is before the market even opened, into the market open, the Russell was the weaker of the products. And we literally said, listen, whatever the market sell side activity is going to be, it cannot be done on the back of the Russell. The Russell at this point has been sold off into an oblivion. So have, of course, the financials. The financials are down right now. They're actually leading, in terms of where they're at. They're only down like 2.3%. You start to look at like energy. Energy, that is just hideous, down over 4%. That one's a little bit of a shocker. But where the sell side activity, shifted to today, and again, this is what is so critical about this marketplace right here, right now. We're going to look at the IWM, and I'm going to apply auto expected moves. Now, people, listen, you can see orders working all over the place today. All right. This is not exactly like a wild day for me. Monday, I was rolling stuff like a mad monkey over here, right? But today, this is sit back and allow a lot of these duration positions to come in. Cover that more in just a moment. Again, if you take a look at the IWM, the Russell, right? And it is just getting smoked outside of the edge of the expected move. Now, in a situation like today, I'm not going to go back and explain everything there is to know about the expected move, because on these evening videos here, we've done that pretty much ad nauseum. We are literally, beyond double the expected move in the IWM. You cruise over to something like the spiders. The spiders, are literally sitting on a 2 sigma move. As I said, I'm going to get into the statistics of the sell side activity. But, if you take a look at the QQQ, the Nasdaq, it is barely outside. In fact, the Nasdaq sell side activity didn't really pick up until a little later in the morning, and started to, as the sell side activity really started to proliferate. This is the key right now to the marketplace. The key to the marketplace is simply understanding that the Nasdaq is playing catch up to the downside. It's not 2 sigmas outside the expected move. I mean, you take a look at this week's expected move. We started somewhere around, 285, we're going to call it. It's 285 inside of the QQQ. The lower edge of the expected move, somewhere around 276, is about $9 in terms of an expected move. Are we $9 outside of this? 276. Take it all the way down over here. I mean, people, we're nowhere near like a 2 sigma move here in the QQQ. My mouse is actually on right now where a 2 sigma move would be. We're nowhere near it. And that does not actually bode well for the remainder of the week. Not because I don't think we can rally. And I want to make something clear. Just because I said, the market bears are making a comeback, I don't want that to be a bearish connotation in any way, shape, or form. The marketplace could bounce. The problem that you've got this week is huge earnings are going to come out. And those huge earnings, and they're going to come out on Thursday, after the bell, those huge earnings could actually spark wicked sell-side activity, and we could see 2 and 3 deviation moves. This is not, okay, a warm and fuzzy feel that you should have into the remainder of the week. I'm also going to detail that right here, right now, and then we'll come over to volatility. If you take a look at the SPX, I said it moments ago, the SPX expected move for the week, right, was about $78. And that's $78 higher or $78 lower. Obviously, here's the start point for the week. Where are we right now? All the way down here. Okay. Down here has a name. Okay. We are just beyond 2 sigmas. 2 sigmas is somewhere right around, okay, the SPX 3300 level. Just give or take a couple of points. So a 2 sigma move, all right, is right around this 3300 level. Where are we right now? Oh, 3280. We're almost 20 points outside of it. So we're actually beyond 2 sigmas, working almost on a 3 sigma move. And I said this on Monday. I said, because on Monday we closed just north of the 1 deviation move. I said the higher probability is always to close inside of the expected move. Nevertheless, as I said, if we get outside, things get wicked. They get wicked in a hurry, and you're seeing that right here, right now. Okay, this not warm and fuzzy. Obviously, we're beyond a 2 sigma move, and we're sitting down here with the fact that the Nasdaq, which has a huge amount of influence in the marketplace, the Nasdaq right now could absolutely unequivocally have room to run to the downside. With that, I want to take it back to the S&Ps for just a second. Get level centric right now. Okay. Get familiar with a couple of very, very key points in here. One of the key points happens to be none other than 3211. Now, if you're looking at this and you're like shaking your head, I can't believe he's talking 3211. Yeah, we started the week, right, north of 3400, right? So now we're actually looking. This is a gravity point at 3211. We're a little bit more than a hop, skip, a jump away from that. But again, we expect that we're going to see sell-side activity just continue to push into this cash close with 4 minutes to go. All right, there is no tomorrow. The volume is starting to pick up. Of course, this is where day traders are actually plummeting out of the marketplace into the cash close. And the sell side activity that you really want to pay attention to, again, it's all about the Nasdaq. In fact, I just showed this a moment ago with the Nasdaq, but take a look as the Nasdaq is actually extending itself outside of the edge of that expected move. And again, now it's starting to get a little bit more serious. Of course, everybody wants me to try to handicap what the rest of the week is going to look like. But people, I'm going to tell you right now, there is no handicapping it because you're going to rely upon those earnings. And I'm going to tell you, this could go, all right, the wrong way, and could go the wrong way in a hurry, because after the bell, again, on Thursday, you're going to hear from the likes of Amazon. Do I have to go any further than that? Obviously, you're going to hear from the likes, of course, of Apple. You have the heaviest of heavy market caps. You're going to hear from, of course, Google, right? So all the heavyweights in terms of market capitalization are going to come out. And if anybody actually falls flat on their face, forget about it. This marketplace is going to be very binary into the end of the week. However, with that being said, damage is already done, right? The S&Ps are going to close down 117, 120 points. This thing, the bell cannot go off fast enough into this cash close here. But that isn't the question at this point. The damage is done. Even if we rally back, I don't think we're coming back inside the expected move, okay? But you have to understand, when you're this far outside, at this point, no one cares. In fact, I think you should actually look back at this point in time and do a little bit of regression analysis for yourself. As I said, this is going to be very much, as I called this video tonight, Market Bears are making a comeback. This is less about what I think about market direction. Listen, I wear my positions, out there. I mean, today, listen, I am short over 3,000 SPY deltas. What do you think happens on a down day like this? All right, you rake it in. And these are the days that you live for. I wouldn't say just as a bear, but these are the days you live for, okay, as a trader. Volatility is exploding in here, you feel like there is no tomorrow. Volume's picking up. The bell can't come fast enough. And let's see, what it is. But the points I want to make here is a much more statistical point of view. This far out of the expected move. If you look back, and I just want to give you a visual take. I don't want to get all numerical on you here, but we could talk integers all day. When you get this far out of the expected move, if you look back at any of the recent trade, okay, do you see that far out of the expected move coming back? You don't. In fact, when you're this far out of the expected move, when you start seeing 2 and 3 sigma territory, you start to see what the last time we were making this wicked of a move, we're actually coming into the Corona crash. All right, that's how wicked this particular move is. And again, you got to go, all right, and you got to look back at a tremendous amount of data to see breaches that are this substantial. And people, most of the breaches that are this substantial do not come until late in the week. This is an absolutely hideous move right now. What do we have to compare it to recently? As I said, nothing. The last time that we had a breach of this significance, okay, we were actually back in February, in March of this year. And that's how wild this market has become, literally, all right? This is overnight. Coming to the edge of the expected move is one thing. 2.5 sigma moves, okay, that isn't nothing. This is something. It is a statistically significant move. You're looking at a 4% move inside of the Nasdaq, all right? Not exactly, again, a warm and fuzzy feeling. The VIX, we're back in the 40 range. Now, as I pointed out on Monday, it wasn't the VIX that grabbed my attention. It was short duration volatility. If you haven't looked at short duration volatility, this thing actually clipped into the 50 handle today. The VVIX, we also looked at this on Monday. That thing is clear to 150, people. All of your risk assets are going nuts. The last thing, though, that I think is incredibly important, as I said, this marketplace, okay, can't close fast enough right now. We're coming into the closing bell here with the S&Ps down about 120 handles. Again, you're going to see bursts, huge bursts of volume coming into this cash close. And it's still, S&Ps are going to be open, 15 minutes after the cash close, okay? And there could still be more sell-side activity into this. The Nasdaq down over 440 handles. The Dow almost facing a 1,000-point loss on the trading session. So back over taking a look at volatility. Again, a lot of people look at the VIX back in the 40 handle. Doesn't interest me all that much. It has to do with risk on or risk off assets. And there is something that's been baffling me a little bit. And it has everything to do with the bond market. The bond market saw wicked sell side activity. Okay, bounced initially on some of the sell side activity, but today's a question mark. This makes me very, very nervous. I don't like what I am seeing right now inside of the bond market. Why? Okay, the bond market could be indicative of a full-blown liquidation event. Why are they actually flat bonds right now? Where's everybody running to? Are they running into the dollar right now? Okay, the dollar is absolutely bid. They're decimating gold because the dollar is bid up. Think about that for a second, because I've talked about gold not exactly being a safe haven. Everywhere you look, there aren't really any good asset classes to go to. You can look at the advanced decline line. GE is the only thing that ended positive on the day, which is news driven. Okay, where are you going to run to? We need to be extraordinarily careful in the days to come. You know what? Push the election aside. Push any news about the coronavirus aside. Okay, you got to focus on the statistical side of the marketplace. The Nasdaq right now is going to be the leader in this race. And the earnings that are going to come out on Thursday night, this is going to be an extraordinary binary event. Coming into Friday, you're going to be sitting pretty much on pins and needles because, again, this marketplace could see incredible losses if any of these major tech stocks are to fail. Keep it in mind. Again, that's it for tonight. S&Ps, again, getting decimated down by the tune of 3.5%. Have a wonderful evening, everybody. Bye-bye.